closer look at the broader markets. Let's bring in Michelle Schneider, MarketGauge.com, partner and director of trading research and education, and Alessio DeLongis, Invesco Investment Solutions senior portfolio manager. Nice to see you both. Michelle, we'll start with you. What do you make of this little rally to start the week ahead of that CPI data?
Well, I've seen forecasts ranging from anything from like 7.3 to 9.3. So there's a wide range of expectations. Clearly, I think the market feels that it will be softer. That's what we're seeing here. What's been a bit bizarre, though, to that is yields actually rose today and the TLTs closed near the lows. So it's going to be very interesting to see if this has been a market that's gotten a little too happy. Also, I think, obviously, Ukraine-Russia situation helped that as well. Or whether this was, another one of those sell rallies, because we're still stuck very much in this trading range.
Michelle, what do you make about the mixed messaging on sentiment, right? We had the New York Fed survey out this morning saying that of the respondents, they think that inflation has peaked. They actually think that inflation will continue to improve. A lot of that has to do with gas prices, yet some of the other data out there has been mixed. What's your read just in terms of sentiment right now and how strong the consumer is at this point in the cycle?
Well, the consumer is relying a lot on credit. Credit card debt has gone way up. And now they also have another concern, which is the potential railway strike that could be coming up by the 17th if negotiations aren't met for higher wages and better working conditions. So I think right now the consumer is in a situation where the philosophy is sort of things couldn't get much worse, but I don't know if that's necessarily true. In terms of inflation, even though we've seen softer prices all around in many, many areas, there's still tremendous concerns, obviously, with energy in Europe, but also even with food. And I think people seem to forget that the drought situation we've had, and now if we do get this strike, the supply chain, and just in terms of supply demand, is precarious. So the consumers are buying ahead, and by the way, staples are down, discretionary is better, so they're cheerful, but we'll see how long that lasts.
Potential rail strike, easily the most underrated story in our economy right now. Alessio, let's dial you back in on your interpretation of this rally ahead of the CPI number and your expectations really the next couple of weeks as we await the next rate hike from the Fed.
Yes, I agree with Michelle. I think right now we're going through a trading environment and a sentiment environment that is a little bit more supportive. There is good expectations that CPI, that inflation broadly will fall. I think that's a high probability outcome, but we are not seeing the pass-through effects of lagged policy tightening. And to your point, Dave, we are still probably halfway through this tightening cycle, right? There's still room to come. So we agree with Michelle that it's tough to say that a major slowdown or potentially a recession is to be avoided because of this rally. And from our perspective, these rallies are good opportunities to lighten up a little bit on positions and sell some cyclicals, buy some defensives, and increase bond exposure in the portfolio, given that we're seeing very attractive yields for the first time in a long time.
So let's see, does that mean that you're staying away from some of those larger tech names? Apple today, one of the big outperformers in the market, closing up nearly 4%, the best one-day gain that we've seen there since May. Is it still time to take that risk off the table and maybe not place your bets on some of these larger cap U.S. tech giants?
That's a great question because of the particular nature that tech carries from a cyclical perspective. My answer would be no. Tech is actually a more defensive sector nowadays. We shouldn't look into the rearview mirror of the performance of year to date, because that was really driven by a major rise in bond yields that hurt large revenue companies such as big tech. But if we can with some level of confidence say that rates are closer to the peak, let's say if they were to peak below 4% on the 10-year, the defensive qualities of tech should really begin to pay good performance in the portfolio.
Michelle, your thoughts on that in terms of big tech, and it really is a handful of stocks that had led this rally. And if I could tie one more to that, because it feels like it's trading like a tech stock, Bitcoin now over 22.4.
Well, it's interesting about Bitcoin because right now it's still into big resistance here. I mean, we haven't really cleared any major moving averages. We did in Ethereum, and now that's come off a little bit relative to Bitcoin. And Bitcoin seems to sort of follow exactly what Alessio said. The tech component which of course is going to be not only interest rate sensitive, and if we have peaked, great. I'm a little skeptical on that. But I would not necessarily find September to be the classic time to invest in Bitcoin. It could easily roll over at 23, 24,000 or even from here. But I do want to say with all the tech, the semiconductor sector is well underperforming. All the major sectors right now have taken back their 50-day moving average, including, by the way, all the indices. But SMH, the semiconductor sector, is still in a technical bearish phase. So that also is another maybe potential warning, especially with something like Apple or NVIDIA that are very, very dependent on the chip technology going forward. So we'll have to see there. I feel like we have the possibility of a soft landing, possibility if supply-demand can stay relatively in check with one another. But yet I also feel like we're constantly fighting barbs along the way. And so I would exactly what Alicia said, I would be taking this opportunity to lighten up and take some profits.
Well, let's see, what do you think just about the probability of a soft landing? Do you think the economy is going to be able to hang on here during what is a very uncertain time and what could be a pretty volatile couple of months?
It's really a question of when more than if, in my mind. The lagged impact of monetary policy has very variable lags, and it's very difficult to predict. The amount of tightening that is taking place and the amount of correction that has to happen in the economy to rebalance the inflationary pressures is substantial. Avoiding a growth recession or an outright recession with negative growth rates over the next 12, at some point over the next 12 months is very difficult. Will it happen year to date? Will it happen by the end of this year? That is the more difficult question. So investors have to be patient and stick to their discipline. This is a slowing growth environment. And also when inflation slows, nominal earnings are hurt. We shouldn't forget that. Profit margins are expected to come down. So it's important to be defensive and not overly obsessed with every single data point to seek validation or dismissal of that recession hypothesis.
Alessio DeLongis, Michelle Schneider, thanks so much for joining us today.